middle of the 21st century, 1 in 6 people will be over the age of 65. That's up from 1 in 11 in 2019, according to a report from the United Nations. So what does it mean when you're planning for retirement? We've got Nick Nefouse, who is the global head of LifePath at BlackRock. Thank you so much for joining me, Nick.
Thank you for having me.
So that's a lot. That's a big demographic shift. And if you're planning for retirement, you have to plan for that part of it as well, maybe limited spaces on wherever you're planning to live. How should people think about that demographic shift?
So there's a couple ways to think about this. First, if we think about in Canada, the average person is going to spend 20 to 30 years in retirement. So it's a very long time period. And what we're finding in Canada, as well as in other developed markets, people aren't necessarily working longer. So most people are still retiring in kind of their mid-60s, and then we have 20 to 30 years to plan. And what we found is with the shift from defined benefit, where the corporates were taking care of this, to defined contribution, where the individuals are taking care of this, we found a lot of confusion.
Now, you alluded to it. People are also living longer. It's not just a lack of babies sort of phenomenon.
Right.
It's the fact that lifespans are increasing. But yes, you're maybe still stopping work at 65. Does it also change, that traditional notion of 60-40 split? Are we going to see a greater generation of income-oriented investors?
We're going to need to. So you're absolutely right. And when I think about this over time, this is a multi-stage problem. So we have to have people invest when they're young for growth. We've got to add more protection around the point of retirement, because we can't just take more equities for the sake of taking more equities. If we do that, then you increase different levels of risk. So we have to balance risk out over a lifetime.
You brought a chart along with us that shows life cycle. Just walk us through that chart and how that's changing these days.
Sure, and thanks for. I didn't want to say this before going to the chart, so thank you. So what this shows is it shows the different colors are the different risks that individuals face over their lifetime. And the point and the reason why I love showing this chart is they change. So a lot of times we think of risk as only market risk, but the risk for a young investor isn't really market risk. It's not saving early enough or not saving enough. They don't have very much money. They're saving every 2 weeks. So volatility, believe it or not, helps those young investors. When you get closer to retirement, we have these really tough risks, things like sequencing risk. That's what happens if I hit a bear market right before I retire. So we have to balance those risks. And then in retirement, longevity risk, how long are you going to live, is an important one to consider, as well as inflation. And we've all realized the inflationary risks that we've seen in the last few years. It just affects people at different points in their life.
I think that's a good point, because for a younger generation of investors, I feel like I get guests on all the time that say we're close to a 10% drop, a 20% drop. Younger investors, they probably shouldn't care that much about it, as opposed to somebody who is nearing retirement, and picking your spots matters.
Correct. So think of it as grow, protect, spend, GPS. When you're young, you want the growth. Protection, that's where you want to get as you're closer to retirement, and then it's spending in retirement. And one thing that always bothers me, people ask us all the time, what should I do with our money? What should we do with our money? And I think about this of the individuals need to just save more, particularly those young individuals that's saving more. And I always joke that I look for these precedented times. I've done this for 21 years, and nobody ever says we're in a precedented investment environment. It's always unprecedented. That's how it is. That's how markets are. So we have to get people saving for the long run.
I feel like it's harder because of social media. Everybody sees what their neighbor is doing, keeping up with the Joneses. It's a lot easier to know what the Joneses are doing when you're following, all these influencers.
Yeah, absolutely. And all we try to tell people is I like to make the analogy like health or fitness. We can make little steps every day to walk 10,000 steps or to work out or to do whatever the fitness is that you want to do to eat well. We have to look at retirement the same way. We want to have high longevity. We want to live a long time. We also need to live a long time with money. So we have to save the right amount, we have to be in the right investments, and that's what we're trying to do at LifePath.
I also think that the time that you came up in the markets matters as well. For a generation of investors, they experienced the 80s, the dot-com bubble, and the financial crisis.
Right.
Then after that new generation, what did they really face? COVID, but that was that did not train you on what a bear market is like. And this idea of FOMO, fear of missing out, taking hold, that's a different psychology altogether.
Yeah, it definitely is. And again, when we build products like LifePath, and this is what about 18 million Canadian investors are invested in through their corporate plans, what we're trying to do is build balanced portfolios, because for those young investors, it's mostly equities and equity-like securities. As we get closer to retirement, it's inflation protection, so real estate, infrastructure, still equities, as well as some fixed income. So that balanced portfolio over time
You must be seeing a growth, though, of alternatives and interest in those alternative assets.
We absolutely do. In some markets that we're invested in, so I think of places like Australia, there's a higher usage of private markets. The UK is moving that way. The US hasn't really moved for a number of different reasons. Canada's somewhere in the middle. Where we are seeing the alternatives, though, that we already have in our portfolios are things like publicly traded infrastructure, publicly traded real estate.
Nick, thanks so much for joining us.
Thank you.